Okay, greetings all. Nice to have you with us today here at the dog days of summer. And does anybody know why they call it the dog days of summer? I don't even know if our special guest knows, as intelligent as he is, but it has to do with the dog star, the Sirius star, which I guess comes out especially in August. So we're dealing with the serious moment right now, and actually there's probably nobody more serious to talk to about financial markets than Jesse Felder. And really, one of the very biggest benefits of my long career in the financial industry has been able to meet a multitude of people who have far greater intelligence than I have. And right at the top of that list is Jesse, who is absolutely one of the most independent thinkers. He's totally, not only is he independent thinking, he's courageous, which I think in our industry is really critical. So we're fortunate enough to have him joining us today. And it's no exaggeration at all to say that when his newsletter hits my inbox, I immediately open it. And that's because they're clear, they're lucid, they're concise, and they always have some great charts. We were just talking before we started recording about how much we like his charts and he's very generous with letting us borrow those for a number of our publications. So if you don't take his newsletter, I'd suggest you do so. It's very reasonable, and he not only gives you big picture ideas, but he also gives you some micro or individual stock ideas. And we'll talk about at least one of those later. And frankly, if anything ever happened to me or I wasn't unwilling to continue to write my newsletters, I would turn to Jesse for him to take up my baton if he would be willing to do that. Hopefully, it won't come to that. I'm feeling pretty good these days, but I do have, as we were talking about right before we started recording, a very big birthday coming up here in about 2 months. So we've got today some of his visuals that I've selected that I thought were the most compelling and relevant, and we'll of course get his commentary on them. And it's fair to say that he's been, as any of you know that have seen his stuff either directly or through us, very concerned about market conditions, and for good reason. But again, he's always the one that says, don't let your macro worries get in the way of your micro opportunities. And micro, again, being a kind of a synonym for individual stock ideas. And I've got a couple of my own at the end, so that will be how we wind things up. And then we'll go into the Q&A phase, which Jesse's welcome to join us, or he can sign off, but depending on his schedule. But I will be here to answer any questions that you have. In the meantime, you'll be on listen-only mode until we get to that. So without further ado, here we have Jesse. And again, Jesse, welcome. Thanks for joining us.
Well, thanks for having me, Dave. That was far too kind of an introduction. I'm glad you brought up, that don't let the macro concerns get in the way of the micro, because I've been probably far too concerned for too long about the macro. And if I had let it stand in the way of the micro, it would have been detrimental to my trading.
Well, that's a great point, because I go through the same thing. People say, "Oh, you're so bearish," and I said, "Well, actually, every week I highlight
yeah,
at least one bullish idea."
right.
And yes, I am concerned about a lot of things about the market, but on the other hand, there's, is it a stock market? Is it a market of stocks? Are there lots of opportunities out there? And typically there are. And it's been more my belief, and I'd like to get your comments on this as we get into this a little bit deeper, that we're going to see more of a 2000, 2002 replay, where a lot of the laggards that, there was a nasty bear market in almost everything that wasn't tech in the late 90s. And then, of course, when the tech bubble popped in early 2000, a lot of those areas like energy, which I know we're going to talk about, but also financial stocks did very, very well, even as the NASDAQ went on to lose almost 80% of its value. I think actually at the low, more than 80%. But anyway, I
Yeah,
don't want to steal your thunder, so I'm going to
yeah,
turn it
no,
over to
we'll
you.
get to that. I think it's really interesting to talk about how things might play out in the years ahead.
And I think, in fairness to you and to me and other people who've used valuation metrics as kind of the North Star, even though we often say valuation has nothing to do with timing, what has been a challenge for us has been this just tremendous, these oceans of liquidity that have been coursing through the financial system. And so that's why I have this slide to kind of open up. Is this a market that truly is inebriated on all this excess liquidity? So when we look at something like one of your favorites, you got to say, wow, this is really something.
Yeah, this was actually an indicator I built for the first time recently in the last couple of months. And, the Buffett yardstick is one of the measurements I've followed closely for a long time, which is, what an indicator that Warren Buffett introduced in a Fortune magazine article back in 1999 at the peak of the dot-com bubble, where he said, perhaps the best measure of stock market valuation is the total market cap relative to GNP is what he used, gross national product, but essentially GDP is kind of what we use today. And so, that's kind of a price to sales ratio. And then, I also added in the Q ratio, or Tobin's Q, which is kind of a price to book value ratio, the market cap relative to assets employed in business. The Shiller PE ratio, the price to cyclically adjusted real earnings of the S&P 500. And then the final one is kind of an interesting one. It's the real price of the S&P 500, adjusted, real prices relative to their exponential trend. And there's a very clear exponential trend line that goes back in that Shiller data back into the late 1800s. And whenever the markets become, very too high relative to that exponential trend line or too low, it's been a pretty good indicator. So it's kind of like a technical indicator, relative to the trend. So you combine all of these things. And what I found is this metric, out of all the ones that I've looked at, is the most accurate forecaster of 10-year returns into the future. So has a greater than 90% correlation with forward 10-year returns. So that basically just demonstrates the famous, Buffett quote: "The price you pay determines your rate of return." You pay a really high price, you get a really low rate of return, and vice versa. If you're buying in the early 80s, you got terrific returns over the coming decade. Even in the early 90s, terrific returns over the following decade. Same can be said if you were buying in 2009-10. We were talking about this before we started. You buy in the wake of the financial crisis, you had wonderful returns because you were paying a relatively low price. So the fact that you're paying the highest valuations in at least 75 years today suggests that returns going forward are going to be relatively poor. And in fact, when you quantify it, this metric itself suggests that the average annual return over the next decade should be close to somewhere around -5% per year for the next 10 years.
Is that real or is that nominal?
That's nominal.
Okay, so inflation adjusted would be even worse, obviously.
Absolutely right.
So that, we got a slide coming up right after this one that I think gets to why these things happen this way. I mean, you would say, well, anybody with a functioning cerebral cortex would say, when you get into these, extreme up move periods, why would you even be in the market? And I think the answer to that is the momentum. Just like when you look at some of these down phases, like you look at the 1970s there, where it just went down and down and down. It was a great value in the mid 1970s, but the market kept going lower, especially in real terms, inflation adjusted terms, into the early 80s. So there's, in fact, I think that famous Business Week cover story, "The Death of Equities," gets a lot of criticism in hindsight because they said, well, that was a great, signal to buy, but that came out in 1979 and the market didn't bottom it for 3 more years. So just the point that valuation can be very premature, both when the market's, very cheap as well as extremely expensive. So when we look at this next one, we see this factor which has such an impact on what people do. When you get this kind of momentum, and as you point out, this has been a momentum-driven market that has no peers.
Yeah.
So that's what keeps people going. Is just human nature is when you're making money today and you're going to make money tomorrow, and you think, well, I'll just keep making money, and why would I sell?
Yeah. I recently went back and reread Edward Chancellor's "Devil Take the Hindmost," and it's just such a great chronicle of the market manias throughout history. And he mentions, he was writing that book right in like the late 1990s, in the midst of, kind of right around the peak of the dot-com bubble. I think it came out in 2000. But he was writing about, the tulip mania, and he was writing about the South Sea bubble. And, nobody's probably done more extensive research and been a more kind of avid student of market history in these types of episodes than Chancellor. And I thought this quote was especially interesting because he was writing this 25 years ago, that the greater fool method of investment has enjoyed great popularity in the 1990s American bull market, where it's been renamed momentum investing. And when you look at today's market, right, probably the greater fool method of investing is a really good way to explain what has worked best in the last few years. It's where are you going to find the most greater fools to pay a higher price for whatever it is that's kind of at the white hot center of the speculative mania in the market. So this chart shows the isolates the excess return of the momentum factor really since over the last 20 years. And you can see that, there were times when it's done well and then gave back that and then did well and then gave back that excess return. But over the last 2.5 years, 2 years plus, it's had an excess return, generated an excess return unlike anything we've seen in the history of the momentum factor once it's been isolated. And you can see that in flows too. I mean, there's so much money that's flowing into this factor, that it just shows that this chasing returns today is really one of the things that's driving markets. I'd also point out too that passive investing really magnifies this as well. Right. So the more momentum a stock has, the more the market cap goes up, the more assets that flow into passive have to go into those names. And so this part of this is also comes down to, I think, the popularity of passive investing magnifying these greater fool effects that are already happening kind of in these speculative names. So it's the combination of the two things: chasing returns, and then also passive kind of magnifying those effects on top of it.
Very good point. I actually heard a podcast with, they called them Eddie Chancellor and Grant Williams, and I forget who the third was, but it was a fascinating podcast. He's a very articulate guy, got a great British accent that always helps. Always makes you sound smarter. But one thing about this chart that's interesting, I really had noticed before, but I think you're aware, and certainly a lot of our readers and people, our top subscribers that are with us today, know that I pay a lot of attention to multi-year trading ranges and breakouts from those. And you can see the big breakout of this one happened in 2018. And man, momentum really did well there for a couple of years. And then, we had the COVID event, and then we had the 2022, well, it was the obliteration of the crazy overpriced stocks, as I was calling it at that time. And so it does get carried away. And the point I was going to make, we've had kind of a series of these upside range expansions over the last 7 or 8 years, but now it is so extended. I mean, you could see from the past when it got really extended in 2021, and then again in 2023, some bad stuff happened, but they were nothing like where we're at today. So I think anybody that's chasing momentum really has to be on guard for a major sell-off.
Absolutely. And you look at the names in it, this isn't just the big tech names, although they are a part of it, right? You have, the big semiconductor stocks in here. We also have names like Walmart and Costco, which Costco trades something like, I don't know, 50 times earnings.
50 times earnings, right.
And so, it's a lot of names that have done really well, but the valuations have gotten to the point where they're truly obscene. It is really reminiscent of that nifty 50 time period. Even the dot-com bubble, I think a lot of people forget, it wasn't just the dot-com names in the late 90s that became so overvalued. Coca-Cola. I mean, I think Buffett even contemplated selling down his Coca-Cola because it became so overvalued. And so you have a lot of these
GE, Gillette, all those things were trading at 40, 50 times earnings.
Absolutely. And so you have a number of those stocks that are in here in this momentum factor that are, have just basically benefited from a massive valuation expansion.
Yeah, I actually think you could make the case that some of those types of names, I mean, Costco being a good example, great company, but probably a 10 to 15% earnings grower that's trading at, a GARP ratio, a PEG ratio, PE to growth rate of what, 5 times, 3 times, something like that. That's a big number. And so
and based on that, on its PEG ratio, it's probably 2 to 3 times more expensive than NVIDIA. So, so go figure.
Right. No, that's true. That's where I think some of these Mag 7 names actually don't look that bad relative to their growth rates. But we're going to talk about that in terms of all the spending that they're doing and how they might be overstating earnings. But we'll get to that here shortly.
Okay.
So this one is your momentum factor. And then this is doing, I think, like a fast forward 18 months later, what happens after you get these big outperformances? Is that the point of this one?
Yeah, you can look back over the last number of years where we've seen this momentum factor really take off in terms of popularity. You pointed out in 2018 it really started to take off, and you can see that the rate of return, the 2-year rate of change, is kind of what this blue line represents. So we've had these waves where you've had these 2-year periods of really strong performance of the momentum factor, and then it gives them back over the next couple of years. And really what's interesting here is the amplitude matters, right? The more dramatic the 2-year return has been, the bigger the give back has been, right? So you had a really good run until in 2020 and 2021 in the momentum factor. And the give back in 2022 and 23 was really painful for the momentum factor. But this latest run higher that we've seen over the last 2 years is really bigger than anything we've seen. And if this kind of pattern holds, it suggests that the give back and the momentum factor over the next couple of years could be especially painful.
Well, I totally agree. And I think most investors forget that in 2022, it was the S&P ended up down 18% or so. But a lot of what I was calling the cops, the crazy overpriced stocks, so that we had in 21, that was kind of peak meme stock mania, when GameStop and AMC theaters and I think BlackBerry, there were a number of stocks that just went absolutely vertical. Of course, the ones that had the short squeeze were just the most extreme example of that. But those things went down 70 to 80 to 90% in 2022. Just absolute bloodbath. And that's kind of what your chart is pointing out. And
Yeah.
I think you're making a very important point here that it could be worse this time. I mean, it's hard to go down more than 70, 80%, but maybe we will see some of these go down 95%.
Yeah, absolutely. And the momentum factor itself, right? If you accept that the stock market is overvalued, and I think we're trading at something, I don't know, 20, 26, 25 times forward earnings. And that's, embedding a certain amount of earnings growth, which we're going to talk about over the next 12 months. The momentum factor itself trades as a premium to the market. So 30 plus times forward earnings. I mentioned a couple of those names are good examples. When you do get a sell-off, really kind of what helps to end that sell-off is where does value come into play? Like when do things start becoming relatively valued and attracting capital back into the market? Well, when you have some things that are 35, 45, 50 times earnings, they
Or
have to go
sales.
down before they can appear attractive to traditional value investors. They do have to go down significantly. I mean, there's not going to be, and that's one of the interesting things, and Devil take the hindmost that Chancellor points out, is that when these things turn, and most of the time there is no specific catalyst, they just run out of momentum. When they run out of momentum, a lot of times there's no bids because right, if everyone was buying because of the strong momentum, right, once they run out of momentum, all those buyers turn into sellers. And then the other traditional buyers that come into the market don't really find any value yet. And it takes a while, a significant decline before they can offer the type of value that appeals to other types of investors.
To your point, if Costco was to go from 50 times earnings to 40 times earnings, I think most rational investors would say that's still not cheap enough. It needs to, bring me up when it gets down to 20 times earnings.
Exactly
So
right. Yeah.
and it seems impossible that would happen, but that's really been the history. We had the chart up a moment ago talking about the Nifty 50 stocks, and a lot of those Nifty 50 stocks, they were popular in the early 70s, and it was a very narrow market like it is today. So very few stocks were driving it, and a lot of them were 50 times earnings, which at the time seemed outrageous, and they did perform horribly for the next 10 years. But as you've already alluded to, I mean, we do see situations where they're selling at 40 to 50 times sales. I mean, those are the extreme examples.
Yeah.
I think
Or
Palantir got up to 70
130
times.
times sales, as is the case in Palantir.
Is that what it got up to? Is 130? Wow.
Palantir's 130 times sales, or it was before it had its recent corrections, probably still over 100 times sales. But
I have to admit that I did short a little bit of it here recently. I thought it was so crazy, and I got lucky on that one so far, but don't ask me about Carvana. Okay, let's move on. So this is interesting, I think, in terms of insider activity, because you've been pointing this out for well over a year, that insider selling has been very intense.
Yeah.
And so that's clearly what's happening today.
Yeah, this is one of the things that I've followed probably most closely for my entire career. I started my career in Bear Stearns in the mid '90s and left to co-found a hedge fund. And really, a lot of our research back then was centered around in legal insider trading, right? What are the top executives doing with their own money? And there's terrific opportunities can be found, by using this data. One of the best examples I like to give is Bill Stieritz. He's probably the most successful insider trader I've ever seen. Was the CEO of Ralston Purina, came in and wonderful track record through the '80s of taking that company and turning it into a massive success. Did the same with Ball Corp, which was a simple maker of glass jars and aluminum cans. And you look at that stock chart, and it's up 40-fold since 2000 when he
Wow.
took over the company in the late '80s and started buying, putting basically essentially his entire net worth into the shares of the company. So there are opportunities like that you can find. As an aside, he's the chairman of Post Holdings today, and has been buying some stock recently in Post. But when you aggregate insider activity, it can actually be really revealing about, okay, what does what do the leaders of corporate America, what are they doing with their money? Are they investing more in their own shares? Or are they liquidating? And it can be a really good, actually, Najat Sehun's professor of business at the University of Michigan's business school. And he's really quantified this and showed that, this aggregate measure of insider buying versus selling is one of the best predictors you'll find of the economy and earnings over the next 12 to 18 months. And so it's really telling. And in fact, according to his data, insiders have never been more bearish than they are today. You have more companies more insiders selling their own shares relative to buying. That ratio has been more skewed than he's ever seen in the history of his data set. So this is kind of a similar data set. I'm just comparing dollars sold to dollars bought. And over the last year and a half, we've had about $25 sold for every dollar purchased by insiders in their own shares. You can see the only time we've kind of been at this level before was really late 2021. December 21 and January of 2022 was kind of the only time we've really seen this kind of extreme in insider being, this bearish in terms of trading their own shares. So what does that say? What does that mean? That tells me that insiders probably are not very bullish on the economy and earnings going forward, and especially where their stock prices are trading at relative to those things, right? So I think this is one of the most important indicators I follow, and even if you look back into late 2014, 15, we saw this indicator get pretty elevated, and stock prices went nowhere for 12 to 18 months after insiders got bearish at that time. So I do think this is the leaders of corporate America telling you it's time to be cautious.
Well, you mentioned the impact on earnings, and I think that's what we have coming up here. So let's see if I can get that. There we go. So yeah, there you go. When you want to comment on that?
Yeah. So this is basically that the red dotted line is just that 12-month insider sell to buy ratio with a 20-month lead on earnings, kind of inverted, and then with a lead on earnings. And it basically shows you, insiders, predict the earnings cycle. Insider, in aggregate, they're telling you when they're very bullish, earnings tend to do well over the coming 20 months. When they're very bearish, corporate earnings tend to disappoint over the following 20 months. So the fact that they've been so bearish now for the last 18 months suggests that over the next year and a half, likely earnings are going to really disappoint. The Wall Street consensus, which right now I think forecasts about a 10% increase in earnings over the coming 12 months. Insiders are telling you it's more likely, based on this relationship, more likely that earnings are headed for a 20% decline. So, if they're right, this is clearly not priced into the stock market right now.
Good stuff. Thank you. Okay, we've got another one that is a major red flag, and that's the market halitosis, the bad breath, as I call it. And
Yeah.
this is definitely one of the worst breadth readings we've ever seen, which gets to what I said earlier about how narrow this market is, very reminiscent of the Nifty 50s in the early 70s. But what would you add to that, Jesse?
Yeah, I mean, another chart that I shared that's relative to this basically just shows the NASDAQ and then the percent of its NASDAQ components that are trading above their 50-day moving averages. You can see we recently made new highs in the index, that's the blue line, and the percent of stocks trading above their 50-day moving averages was less than 50%. So less than half the stocks were above their simple moving average while the index made new highs. So that suggests that there's just a very limited small group of stocks that are driving the market to new highs. It's sort of similar to what we saw in December and January of this year before we're that steep kind of March and April correction that we had. And it's kind of a warning signal that under the surface, things are not as good as it would appear from just looking at the index itself. I'd point out too that with this new high in the NASDAQ, it's the first time in the history of Bloomberg data that we made a new high with less than 40% of the components trading above their 200-day moving averages. So, I tried to find a precedent for that, and it goes back to 2001 or two in Bloomberg's data set. And that's the worst breadth reading we've seen in over 20 years on this recent breakout to new highs in the NASDAQ.
Well, that's pretty shocking. I do think it's fair to say that there has been some improvement. There's been a little bit of broadening out here lately, but it's hard to say that that's going to continue. There's been other examples of that recently, and then we go right back again to this poor breadth situation. Okay, so this is the history rhymes situation, quoting another, well, in this case, Edwin Lefevre. Nowhere does history indulge in repetition so often or so uniformly as in Wall Street. I actually read a related quip here recently, which was, I think, from Voltaire, that history doesn't repeat, but people do. And I guess I would add, especially their mistakes.
Yeah.
So, time goes by, time's an
Yep.
amazing memory cleanser.
Absolutely. There's so many wonderful quotes, about history rhyming, whether it's Mark Twain or, that sort of thing. But I quoted Edwin Lefebvre, who was, a journalist operating back in the 1920s, kind of chronicling the 1929 stock market crash and the bubble that led up to it. It's just interesting. There's a really high degree of correlation actually between the current market. This is the S&P 500, over the last few years, really since the 2022 low to the recent new highs today, and the last couple of years of the dot-com bubble in that 99 2000 kind of top. And if you kind of they don't sync up perfectly in terms of the calendar, but that late kind of high that we saw in 2000. I believe the New York Stock Exchange composite made a new high in September of that year. The NASDAQ failed to. So we're kind of like in an opposite scenario now where the NASDAQ is making new highs. NYSE, I believe, made new highs, but small caps are still well off their highs. And most notably, I think the Dow Transportation Average is well off its highs. So you have a kind of a Dow theory issue there. But basically, it's interesting to note that if we are seeing kind of a repeat or a rhyme, if you will, of the dot-com bubble in the AI bubble today, the market is kind of acting in very similar fashion as it did to that time when it was kind of going through its blow off top in 2000.
We'll get to the AI situation here very shortly. But this is another bubble warning that you've got. This was a tweet that you ran here fairly recently. What's your main
this comes from
takeaway here?
Schwab. I'm sorry, not Schwab. This is a Bloomberg. I'm spacing out on her name, but she's the chief equity strategist for Bloomberg, and she pointed out that the concentration and valuations are more extreme today than any point since the dot-com bubble. You have like the valuations are very close to what we saw in terms of forward priced earnings ratios. Now, as I showed in that first chart we started out with, based on a kind of a more holistic measure, price to sales, price to book, and these types of things, Valuations are far more extreme today than they were in 2000, but based on the forward price earnings ratio, we're not quite as expensive as we were back then. But concentration risk, in fact, I think it's 40% of the S&P is in just a handful of names right now, and they're essentially all involved in this AI trade. So the market is actually far more concentrated today than it was in 2000, which is basically tells you that back then in 2000, the broad stock market wasn't as exposed to the dot-com bubble itself as the broad stock market is exposed to the AI bubble today.
Yeah, we will get to that. But before we do, we've got one of your favorite timing indicators. And I was looking at this, fairly carefully. And even though we've been in this seemingly endless bull market for, basically the last 15 years or 16 years, it's actually giving you some pretty good sell signals.
Oh,
And,
absolutely. I mean,
and it
whenever
looks like we're in the
whenever
danger zone again, right?
Yeah. And this is one I watch closely along with the Hindenburg Omen. And both of those are very similar indicators. It's you have a stock index, in this case the Nasdaq, making a new high, and under the surface you have lots of new lows being made. And so with the Hindenburg Omen, you need, I think it's more than 2.5% of the components making new lows. And that's not a sign of a healthy market. When the index is at new highs and you have a rising number of new lows under the surface, new 52-week lows, that's not the sign of a healthy market. So when you get, obviously these indicators are created as like a crash signal, like stock market's going to crash. This is kind of the Hindenburg Omen. But when you get one of those Hindenburg Omens triggered, or one Titanic syndrome triggered on one day's trading, it's not really that valuable of a signal, right? These types of breadth warnings tend to persist for longer periods of time. It's only when they start to add up over a period of time that they really begin to matter. So in this chart, you can see over basically a look back over a 12-month window, how many Titanic syndromes were triggered on the NASDAQ. Well, in 2022, we got to the point where 22 of signals were triggered over a 12-month period over that 2021 kind of bull market blow off, and that was a really good signal. Well, this I believe is kind of late last year when we saw this signal hit a new record. I would just point out too that it's even more extreme in terms of Hindenburg omens on the NASDAQ. It's what the number of Hindenburg omens that we've seen over a 12-month window on the NASDAQ is far greater than any previous period. I mean, this made a slight new high, right? 41, which is saying something, right? We didn't see anything close to that during the peak of the dot-com bubble or in the lead up to the great financial crisis. The fact that we're seeing record numbers of these is a pretty interesting breadth signal. But the fact that in terms of Hindenburg omens, we not only set a new record, but it's almost double the previous record, I think is a very telling signal as to just how narrow this market has become, how reliant it is on just a handful of names. And as I've mentioned several times, those names are all related typically to the AI, the CapEx build out.
Yeah, there's another consideration too, and that's just the calendar, which is we're into this period where bad things tend to happen, and we don't know why. A lot of times it's August, July, August, which so far this year hasn't been very volatile. Markets continue to kind of go up with this deteriorating subsurface behavior. But the reality is we've had some terrible market declines in Octobers and then big rallies coming out of those lows.
Yeah.
So the calendar also would be enough to put somebody on alert. But I do want to point out in fairness that, so this is from Michael Howell, Cross Border Capital. He was on my buddy Adam Taggart's show here recently, and we borrowed this chart from him. And to me, this is what's really been driving the market. And I do think, I alluded to this earlier, that those of us that are more value conscious tend to overlook, the power of liquidity. And that when you get this incredible liquidity infusion phase, that the market can keep going up regardless of fundamental considerations. But I would point out that this thing's really elevated. And Michael Howell is worried that next year we're going to see liquidity go the other way. It could even do that sooner because in the case of the Fed and the Treasury, their special liquidity infusions or maneuvers have run out. So like the reverse repo has been drawn way down to where it can really not go much lower. The Treasury General account, which is the Treasury's checking account, looks like it's going to get replenished by several hundred billion relatively shortly. So this liquidity situation is still supportive. And that's why maybe any correction that we see here near term, though it could be sharp and even fairly deep, might be one to buy. But at some point here, I think you're going to see we enter into more of a drawn out bear market instead of these kind of flash crashes. So that's, I want to be fair to those that would argue with us and say you guys are missing the main driver. We talked about AI, and there's no doubt that when AI really broke, which was kind of in 2023, I think it was mid 23, maybe late 23. That's what really gave this next up leg to the stock market, which had had a rough 2000. Sorry. Oh boy, I want to go back.
You can use the left
There
arrow.
we go. There we go. There we go. Okay. So here this is a biggie because we know the amount of spending that's going on to build these data centers is just stunning, and this really puts it in graphic form. So Jesse, what would you add to this, or is it just
Yeah,
self-explanatory?
I recently spoke with Peter Berezin, who, I think he first published this chart. It shows the spend on, the CapEx build out, and it's already kind of peaking. And Peter makes an interesting point. I mean, there's just literally hundreds of billions of dollars going into the build out of this infrastructure. I think there's a number of important points to be made here. Is one that Jim Chanos has pointed out, is that in the short term, this CapEx build out, just like the dot-com bubble did, it creates a boost in earnings, right? Because you get all of this spending, and the spending ends up immediately as revenues for somebody, right? In this case, it ends up as revenues for mostly NVIDIA, but Microsoft is recording a ton of revenue relative to OpenAI's spending on stuff. Google, Alphabet's recording revenue based on companies licensing and using its data centers. That revenue is recognized immediately, but all the CapEx is depreciated over a number of years, so that the expenses don't show up immediately. And so it really creates a massive boost to earnings in the short run. Now, that also hides the fact that who are the companies that are doing, they're creating all this revenue? Where is that revenue coming from? Well, OpenAI is massively unprofitable, right? And so, the revenue that they're responsible for is not going to be sustainable unless they find a way to make money. Same thing for a lot of these companies that are actually buying the NVIDIA chips. It's coming out of their cash on hand. It's not coming out of sustainable AI-driven revenues that are going to enable them to buy more chips and things. So if these expenses were written off on basically the same time frame as the revenue was recognized, you would have essentially no earnings growth from this CapEx bubble. But because based on kind of these accounting, timing mismatches, it creates an earnings boost in the short run. We saw this during the dot-com bubble with companies like Cisco and the companies that benefited from the fiber optic build out, the backbone of the internet. So the other flip side of that is at some point the CapEx spend is going to slow down and reverse. And what happens at that point is actually all those depreciation charges start to really mount. And that's what we're already seeing. Companies like Meta have started to warn that their expenses are rising dramatically, and it's going to start to hurt earnings next year as those depreciation charges start to build. So, I think really it's important to follow the cash, right? What's going on with the cash, right? Because companies are reporting all these great earnings. And I think this chart does a pretty good job. But really the truth of it is, what's free cash flow doing? Free cash flow has reversed and plummeted. And I think a lot of people don't understand. They think of these big tech companies as being flush with cash. Meta is out of cash, right? Apple is out of cash. All of these companies, essentially, when you look at their net cash and back out, debt and operating leases that are capitalized as debt on the balance sheet, they're essentially out of cash. And so that's why they're having to go to private capital to borrow money to now build out these data centers, which is going to get that much more costly. So when you look at free cash flow, right, free cash flow doesn't lie. It's actually reversed lower and is actually starting to go into significant decline year over year. And that's going to manifest in earnings of these companies, right? Free cash flow is kind of like, one of the things, the two things that we used to look at, and we had a short only hedge fund back in the late 90s. And we worked closely with CFRA, which was is really a now big research house. But back in the late 90s, they were a very small firm. Howard Shillett founded.
Howard Shillett, I was going to say, yeah, I remember Howard.
Howard Shillett wrote a great book on financial shenanigans. And I remember I would call Howard up and I'd say, there's tons of insider selling at the semiconductor stock. What's going on? He goes, talk to my analyst. Analysts would come on the phone and say, yeah, look at the free cash flow. Earnings are good, but their cash flow plummeted because they're being too aggressive in recognizing revenue. Well, that's going on essentially through the whole tech space right now. They're all being way too aggressive in recognizing revenue, and earnings and it's manifesting in earnings that are not sustainable. And so I think this is why we see, why there's potentially a problem coming down the pike. And it's very similar to the dot-com bubble. Right? That in order to keep this game going, the spending needs to continue to grow exponentially, and there just are not the revenues there to support it. So the companies, like as I mentioned, they're already running out of cash. They're already starting to borrow tens of billions of dollars to keep this game going, but that's not going to go on forever. And when it stops, it's going to be very, very similar to what we saw in 2021, 2022, as we saw then. S&P 500 earnings went down by about 40% over that 2-year time period. And a lot of that was basically just the result of the earnings that were created in that 2000 time period, not being true economic earnings. I think
because that was actually a fairly mild recession back then. But if in terms of your views about the AI being in a bubble, I think this is one of the most supportive pieces of evidence of that, Sam Altman himself. So what would you like to comment on there quickly?
Yeah, absolutely. Altman has been the biggest cheerleader. The CEO of OpenAI has been the biggest cheerleader of the whole AI CapEx boom. And he's insisted that, the more they spend, then the better these models will get. And they'll eventually get to artificial general intelligence, essentially thinking machines that can think and improve on their own. And I think with the release of GPT-5 over the last couple of weeks, it's been very, very clear that was, rather than a revolutionary kind of exponential leap forward in the technology, it was very incremental. In fact, a lot of people saw it as a step backwards, is worse than GPT-4. So if these models are essentially, plateauing in terms of the technology development, and they're still hallucinating, still have problems with, reliability, and there are no killer products built on them yet that companies can monetize, then a lot of this spending, is going to be, proved to be uneconomic. And I think one of the things that's gotten people worried recently is that Meta has already spent tens of billions of dollars developing its Llama models. It's what they call their large language models, their AI models. They basically just scrapped that entire program, right? So this is Meta telling you all the money we've spent up to this point was complete waste. We're not using any of those models anymore. Llama came out months ago, the latest version of it, and it was a terrible disappointment to the market. And so now Meta's saying, okay, we're starting from scratch. We're starting all over again with a whole new team. And so the fact that all that spending was wasted should be very, very telling as to, and I think that's what Altman's talking about here, is there's going to be a lot of money that's spent in uneconomic forms, and it's going to have, and he even said, quote, a lot of people are going to lose a lot of money. And so when you have the chief cheerleader of AI saying this is a bubble and a lot of people are going to lose a lot of money, I think it pays to listen to him.
I would agree. Well, let's look at the photographic negative of AI and where capital is, instead of coming in a torrents, is fleeing and creating lots of opportunities. And this is really in my wheelhouse here in terms of energy. You've got some just terrific slides here with energy. I'm just going to go through some of these pretty quickly because I know we're getting a little bit short on time, but just
Yeah.
looking at the price versus the positioning. So we've got, as you say on here, that this is the most bearish positioning since the financial crisis. That's really quite something considering that, well, if you've got an excellent one here showing inventories. So
Yeah.
lowest inventory since 1985. I mean, I keep hearing and reading, and I'm constantly pushing back on this idea that there's this big oil glut out there, which a lot of that comes from the IEA, the International Energy Agency, which is such a purveyor of misinformation. And so, you look at this chart, this is exactly what our friends at Cornerstone Analytics, Mike Rothman, is saying, and also Gehring and Rosenzweig, which is this is not a glutted market. It's actually the
Yeah.
opposite of that.
Yeah.
There just doesn't seem to be any enthusiasm at all for anything energy related.
Yeah, and I think a lot of people, are saying you're talking about a glut are they're looking at inventories X the petroleum reserve, the
Correct.
strategic petroleum reserve. So this includes the strategic petroleum reserve. You can see the big decline in inventories there was the releases from the SPR. But I think it's important to look at it all in because if you think about I believe that we probably are in an era right now where the risk of geopolitical shock is as great as it's been, at least since the 1970s, if not since the era of we have the largest land war in Asia since the World War II. We have the worst strife in the Middle East since the 1970s. There is no geopolitical risk premium priced into the
Exactly.
markets
That
right
is
now
such a
at
good
all.
point. That is such a good
And
point.
the fact that the SPR is already drained, is pretty important at a time when you have the greatest geopolitical strife that we've seen in a generation, or if not, 2 or 3 generations. So I think it's really telling. Demand, look, I point this out too. Look back to 2008, right? You did see a time where inventories were going up, as a really, because of the financial crisis, really did hurt demand. Demand went down, inventories went up. But we're in such a dramatically different situation today where demand is 75% higher today than it was back then, and inventories are lower than they were back then.
Well, see, that's another
So
critical point. It's one thing to see inventories in an absolute sense so depressed, but then when you think about what consumption is now versus what it was in 1985, I mean, it's up by, factor, I don't know, three since that time. So
yeah,
adjusted for consumption, inventory levels are just shockingly low.
yeah,
So thank you very much for running that because that just doesn't get the kind of attention it should. Then if we look at flows, and so this is what I was saying earlier at the outset of this section, is that this is where capital is fleeing. And
yeah,
really, if you want to make money in the long run, you want to bet on things like this, unless there's something that's changed where, like there was a popular belief, which I think has faded away not long ago, that oil and gas, was peak usage and that we were going to see them actually, the demand for fossil fuels contract. I think that's now realized to be false. Now, maybe the growth rate is going to be slower. Certainly true in the developed world, but at the developing world, as these countries get wealthier, they're going to use a lot more oil, gas, and even coal. And coal is the dirtiest form of fossil fuels. It continues to set new highs in terms of consumption. So it's, this is not a buggy whip industry, is my point.
yeah.
So when you see this kind of hostility and this negativity in terms of persistent outflows, it's, I think, a fantastic long-term buying opportunity. But
It's
I
also, I
know,
mean, it's astounding to me that if you look back over the last 5 years, energy is still the best performing sector in the market over the last 5 years, and it's
right,
lost. XOP is is the oil and gas producer ETF. It's lost 70% of its assets over the same time frame. It's been the best performing ETF over the last 5 years. I've never seen anything like this.
no good deed goes unpunished.
That's right.
So I created the next one, which is kind of along the same lines. Oh, sorry, there we go. Okay, go right to this one. So at the end of '07, energy sector was 13% of the S&P. It's now 3%. I mean, 3% when you consider how vital energy is to, global economic activity, to have it down to that where it's just a rounding error, that's to me that's another one of the great bullish indicators.
Yeah, I think Nvidia is 8% of the S&P.
$4 trillion
Energy's
market
3.
cap. So this is not an energy name. There's lots of those that I like and I write up all the time, but this is one that's very out of favor. UPS, this is one that I highlighted here recently. So it's been a dog. It's had disappointing earnings and so forth, but it had a big insider buy recently. It yields 7.5%, I believe, at this point. Right, 7.5%. It's a low multiple though on weak earnings. So your view is that perhaps this one is oversold and going to have one of its rallies that it's typically had over the last 10 years.
Yeah, I highlighted it because there was some insider buying by the CEO, which I think is usually pretty interesting. Typically what I like to see is more buying kind of across the C-suite. I like to see,
Right.
CFO, maybe a couple of lower executives buying as well. That's not the case here, but the one purchase was significant enough that I decided to highlight it. That and the fact that the valuation does look compelling. If you look back at 2000, this chart goes back to 2000, the stock was significantly, the blue line is the stock price, red dotted line is its value, a 20-year historical valuation, where the stock price would be if it traded in line with its 20-year historical valuation. So you can see back in 2000, the stock was significantly overvalued relative to its long-term history. Stock price went nowhere for about a decade or longer. Because you were starting from a starting point of overvaluation. Today, that valuation metric suggests the stock price should be significantly higher, based on its historical valuation. So it is a very out of favor stock currently. Obviously people, who are worried about the economy, and with the gig economy taking off and Amazon doing its own deliveries and things, there's been a lot of headwinds for UPS. But it is a stock that looks undervalued relative to its valuation history and has some good insider buying. So these are the types of setups that I typically try to look for.
Well, and I've got one here too that I wrote up here relatively recently, AG&C, which is one of the leading mortgage REITs. And this can be a treacherous area because these guys are pretty highly leveraged and they don't do well in a flat to inverted yield curve situation, which we've mostly had in recent years. But if you believe, as I do very strongly, that we're in a yield curve steepening era, and I think certainly with what the Trump administration is doing, trying to do Scott Bessent to force the Fed to lower short-term interest rates, and that may not lower long-term interest rates. They may even go up a little bit. So that's what creates what's called a steepening curve. It could be a bear steepener, which means that the long rates actually go up. And as some of you are aware, once the Fed cut interest rates pretty aggressively last year by 100 basis points, 1 full %, long-term rates actually went up. So in that, if you just assume they kind of stay the same, if the Fed cuts, by a full %, or if the Trump administration gets what they want, 2 to 3%, 200 to 300 basis points, I mean, that could be just absolute rocket fuel for these kinds of companies. And we wrote up at 9.5. It's moved up to about 980. So it's up a little bit. Yields 14.5%. So when you see that kind of yield, you worry about dividend decreases. But actually, if you look at history, when the yield curve steepens, they actually increase their dividends in those phases. So again, this is it's not for the faint of heart, but we've done well with these mortgage REITs by playing the yield curve shifts. Another area, Jesse kind of alluded to this earlier, small caps. Look at the outflows from small caps. They had a big day last Friday, but in general, they're very out of favor, and I think there's some appeal there. And I would also point out mid cap. I don't have the mid cap flows. I think there have been outflows, but not as extreme. But this is a breakout that we highlighted when it happened. And it hasn't done a lot since then. It had a nice run, immediately after the breakout. But at this point, I still think mid caps, if you want to be in the market, if you think, look, this is going to continue to be a liquidity driven market, therefore I want to have participation, but I want to do it in a more rational way. I think paying 16 times forward earnings for mid cap versus 22 to 24, Jesse said 25 forward on the S&P, that's a lot safer place to be. So if there is a rotation like we saw in 2000, 2002, that was another time where mid cap did quite well relative to large cap. So with that, we've gone longer, I apologize, than we typically do on our main presentation, but a lot of good stuff there. So let's open it up to questions. And Jesse, are you okay sticking around or do you need to hop?
Yeah, No, for sure. And I would just make one more point if I could
Sure.
about small caps is, my friend Eric Cinnamon is one of the premier small cap managers in the space. And
Yes.
I know he's finding value in dividend payers in the small cap arena. The problem with small caps is that it's something like, a huge number of them are zombies. They don't make any money. And so
Gotcha.
kind of to focus on the profitable companies in small cap and especially the dividend payers, I think is kind of an important way to kind of differentiate from why a lot of people have avoided small cap is because there's a huge percentage that are unprofitable.
That's close to 50%. And
Yeah,
that's another reason why, like, so if you're going to play small cap, I think you're better off doing the S&P 600, which is much higher quality, a lot lower. I forget the percentage, but I think it's more like 20, 25%. Still a lot. And
yeah,
that's why I also prefer mid cap.
yeah.
Good clarification. Okay. Who do we have?
Well, I don't know if anyone wants to ask a question in person, but we have a few in the chat. Jeff, do you want to ask yours or do you want me to read it? I'll
Jeff
just
Harbaugh?
I'll just go ahead and read it. Um, how are the quality of corporate balance sheets compared to 2000?
Well, I guess I would take a stab at that and see if Jesse agrees that I think it's a two-tier situation like so many things in our economy. There's a lot of companies that have, terrific balance sheets, although as he points out, some of the best used to be like Apple, and they're not and Meta, they're not as fortress-like as they used to be. But in general, I think where you've got the problems are with the smaller companies that are highly leveraged, that didn't term out their debt, they didn't extend maturities when rates were really low. They've got floating rate debt. So they're really starting to get squeezed. And there's a lot of these bonds, even if they did term their debt out, for lower quality companies, you don't go out 20, 30 years. It's more like 5, 6 years with junk bond financing. So if you assume that they did their extensions back in 2000, that clock is ticking, and we are starting to get to what's called a maturity wall. So I think we're going to see a winnowing out process where the weaker companies really struggle, and you see bankruptcy soar, which is already happening, by the way. And then the stronger companies do just fine. But Jesse, what would you add to that?
Yeah, I would add that I think people are probably too sanguine about the health of the big tech names. That it's true that 5, 6 years ago they had 10, 15% of their market cap in cash, which created a kind of a valuation buffer and obviously a huge buffer in terms of their credit risk. Today, they've taken all of that cash, put it into CapEx, which has gone into these data centers. And one VC, I can't think of his name right now, but he called these large language models the fastest depreciating asset in history. All right. We saw all this money spent, and then DeepSeek comes out and says, we made a better model. And DeepSeek spent a tiny fraction of what OpenAI spent on their model. And so with the new model comes out, it makes all the other models, previous models, obsolete. So if you're taking all of your cash, putting it into the fastest depreciating asset in history, that's probably not a terrific business model unless you can start to generate some revenue from that spending. And none of them have been able to do it, at least profitably so far.
Good point.
Yeah, so we have another one here. Seems that the last bear standing will grab everything when this finally breaks. If they left with some capital until then, I think they mean if they're left with some capital
Right.
by then. Any idea how to play this scenario and defend the current returns?
Sure. And actually, ironically, I was reading the transcript. Doug Cass, who's a pretty famous short seller, who does long short, so he's hedged, but he's still in business, maybe because he is hedged. But he was saying how just what the question was articulating, that there's been such a bloodbath being short that a lot of them are gone. I mean, Jim Chanos, who was legendary, has basically shut up his outside money. He's only doing his personal stuff now. And so it's you don't have a lot of competition out there if you're willing to sell short, but it's just incredibly treacherous, as I can personally attest. I mean, I do a lot of shorting have for years, and it's I've been very successful with ETFs, but I would say pretty unsuccessful with individual names, where it can be really tough to try to limit your losses when you get into something like a Carvana that just goes straight up, even though I've covered it multiple times on the way up. So if you do it, I think you get it with, fairly tight stops. I think one of the best ways to do it, I mean, again, using ETFs is a lot safer. It doesn't eliminate all the risk, but it eliminates a lot of it. But also looking at these trading ranges. And so something that breaks out above our minimum time frame for really pounding the table on something breaking out is 3 years. So if it has a 3-year breakout, you cover your short. Ideally, you might want to enter when it's close to a multi-year high. So if it breaks, you can cover your, take a small loss, get out right away. Invariably, they keep running. And then once they really get extended, kind of like that chart of the momentum plays, momentum securities, then you can come in again. But it's a tricky area. I wouldn't recommend it for anybody that doesn't really consider themselves to be a professional. But Jesse, what would you say?
Yeah, I would say that's absolutely true. I think Stan Druckenmiller said, he's, and, obviously the most successful hedge fund manager of the last 30, 40 years. He doesn't know if he's made any money in total short selling. So if Stan can't do it, it's tough for anybody. I would just say that, if you're going to try it, you have to have some type of risk management. Jesse Livermore talked about, there's a great book, Jesse Livermore, Boy Plunger, about how he profited from the 1929 crash, where he talked
But
about.
he still died broke, right?
Oh yeah. Yeah, he killed himself after trying to go long after he made money in the 29 crash. He went and tried to go too long too early and then ended up taking his own life. So yeah, the one of the most celebrated short sellers in history has a sad ending, tragic ending. So yeah, I would say you have to have some type of risk management. Use either, like Jesse Livermore talked about, taking your losses quickly. I mean, that's kind of a classic trading thing. Just take your losses quickly, or use some type of a trend following approach to where, unless it's trading below a certain moving average, kind of a Paul Tudor Jones-esque strategy. If it's not trading below its 200-day moving average, I'm not going to touch it. Right. I don't want to short things that are in an uptrend. So you have some kind of discipline. I think risk management is critical.
I will say once they really go parabolic or vertical, that just that straight up shot like we saw in Palantir lately, like we see on that momentum chart that we had on, I think, our second visual, you can, I think, go in there kind of lightly. But I mean, if you are risk tolerant, really going to watch it. But in general, I think you want to, as Jesse said, you really have to cut your losses early, which is not really human nature. We don't like to do that. But when you're selling short, you got to do that. And I'm somewhat living proof of the folly of not doing so.
We all are. If anybody who's tried to short sell has painful stories to tell about it not going their way.
All right, next one comes from your own old buddy, Jim Edsall. Given our enormous government deficits, do you agree with Lynn Alden that nothing stops this money printing train, such that at any sign of a downturn or certainty if the market declines significantly, that the government will print and reinflate the bubbles?
Jesse, you have an opinion? I certainly do.
I do. If you study, I've been doing a lot of work on this myself, and nobody's done more work on it than Ray Dalio. And if you read about his big debt crisis and the big debt cycle and things, he talks about, you start seeing towards the end of the debt cycle, the end game, you start seeing signs that tell you you're getting close to the end. One of those is attempting to interfere with the central bank. And that's exactly what we're seeing right now. And you can see why we need to, there's that impetus to interfere with the central bank, because, when debt growth becomes exponential, interest expense becomes a real problem. But when you get to the end of that debt cycle, we would really see it manifest at the long end of the bond market. I think you'd see, and the fact that Japanese yields continue to make new highs, and I think the 30-year Japanese yield just made a record high.
360.
Tells you that there are things going on, and I'm watching the 10-year Treasury yield kind of as my benchmark. But what happens when if you were to get a kind of debt crisis type of issue where those yields spike, is the stock market does not benefit from that, right? The stock market goes in the toilet because the bond market is going to get hammered. Long-term interest rates are going to go up. That creates a lot of, that is essentially a rising discount rate for equity valuations. And what happens is, money floods out of the currency. And when money floods out of the currency, right, that's foreign investors bailing on U.S. equities, who've been really one of the main drivers of the U.S. equity market over the last 2 years, and foreign inflows. So I think this is something that is worth paying attention to. That the federal government is going to be forced to, at some point, if we start seeing the long end really kind of get unruly in a kind of 5, 6, 7% on the 30-year, as a sign of markets losing faith in the ability to get repaid in dollars that aren't dramatically debased. The Fed, Treasury are going to have to kind of do something coordinated that would have to manifest in the currency. And
So you're talking about yield curve control, where they try to artificially suppress the long end of the bond market, which I think they're already vectoring to do. They're being pretty clear that that's
exactly right.
They're willing to do that.
But as soon as they do that, you're basically saying, we're going to allow inflation to run way above target, and we're going to try and deflate the debt. And that means to foreign investors, we don't want to own dollars. Get out of the dollar. How do you get out of the dollar? You sell your treasuries to the Fed, and you sell your equities to whoever will buy U.S. equities, whoever will buy them.
So I know a lot of people on this follow Luke Roman, and Luke is saying he believes the Trump administration wants to see the dollar go down to 55, 65, somewhere in that range. And it's about 100 right now if you look at the Dixie, which is the main dollar index. It's not necessarily the most accurate, but I think you're absolutely right. And I know that the dollar's been kind of oversold here lately. It might bounce, but for those of you that read me regularly know that I think emerging market bond funds and local currencies are, if you're looking for yield, those are one of the better ways to play that, and they look really good on a chart. So something like EDD, if Jesse's right, and I think he is, I think that's a lot better place to be than long treasuries, or even a 10-year treasury, which is kind of semi-long.
Yeah, what? We were talking about Edward Chancellor's. He's writing a book today with Jeremy Grantham, and I can't wait to read this book. It's about the current bubble. But Jeremy Grantham's firm recently came out and pointed out the outperformance of the U.S. stock market over the last 15 years comes down to 2 factors, and it's the dollar and valuations. We've had expanding valuations, but a rising dollar has been one of the primary drivers of U.S. equity outperformance over the last 15 years. So when you look at the trend in the dollar, and this is another one of the kind of big picture things that I've been paying close attention to, is when the dollar is in a bull market, you want to own financial assets. You want to own U.S. stocks and treasuries. When the dollar is in a bear market, you want to own real assets, and you want to avoid financial assets. So if you believe the dollar is entering a new bear market, just like it did from 2002 to 2011, then you want to avoid U.S. stocks and treasuries and overweight real assets, gold, commodities, et cetera.
Thank you, Jim, for the question.
All right, we got a couple more here. Are there Australian uranium miners that are attractive?
Well, I personally own, Paladin. Not Palladium, Paladin. And that is an Aussie uranium miner that Rick Rule is very bullish on. And Rick Rule is one of the best natural resource investors on the planet. However, I believe their main mine is in Africa. And I forget which country they're in, but it's one where they're trying to get more of the profits out of Paladin. And that's a problem. But I know Barrick, the big gold miner's got trouble over in Africa. I think it's in Mali. So it's, these mining is a really tricky proposition, and these governments are becoming increasingly militant and not really governed by a strong belief in the rule of law. So are there the pure plays Australian miners? I guess so. I don't know who they are. I'm always on alert for those. I do take Justin Hume's Uranium Insider, and he doesn't have any great recommendations in that regard. My buddy Trader Ferg comes up with a few. I know he's kind of leery of Paladin because of that African exposure, but so I guess that's a long-winded way of saying I don't have a good idea right now. I feel much better if you ask about Platinum and Valterra. I think Valterra is poised to really run over the next few years with an earnings eruption, given what's happened with platinum prices. And the stock is still quite depressed, but really broken its downtrend. Jesse, do you track? You probably are not as skookum on uranium as some of my buddies. That's not really your area.
Not at all. I mean, people who ask me, I say, if something comes up on or I see some insider buying in something related, then it'll pique my interest. But, it doesn't quite fit my methodology unless I start seeing it pop up on some of those things that I follow closely.
So what we've mostly done is with the SRUUF, which is the Sprott Uranium Trust, that's been very good to us, and we've played the trading range on that quite a bit. It doubled and then sold off hard, and then we bought it and rallied, and then it sold off really hard, and we bought it and it's rallied again. And actually, we recommended taking profits at 18 and went back to 16. Now it's back up pushing 18. So it's that's got a decent amount of volatility, and I just think that's a safer way to play it. But I will continue to be on the lookout for any miners that make sense. You said
All
there was
right.
another one, Adam?
Yep, last one we got here. Do you have any thoughts on multifamily apartment REITs in relation to the ongoing expensive housing situation, and how would this asset class be a hold for higher inflation scenario?
Yeah, that's a good idea. I know that at my former firm, Evergreen, which I'm still a major shareholder in, they're really bullish on kind of Western Washington apartment buildings where there's been a derating. The prices have come down, the cap rates are up, and I think it's a pretty good story. I don't know, I haven't looked at some of those apartment REITs recently, so I can't give you any names, but it's one I'll be kind of on the lookout for. So don't be surprised if I write one of those up, or maybe several of them. Of course, you could always buy the multifamily REIT. Would imagine you'd want to be a little bit more targeted. But yeah, I think there's opportunities there. I do think, since you brought up housing, that housing has got a major, major problem. And it's just, I mean, the affordability continues to be awful. And yet you see these home building stocks basically close to their all-time highs. So it's, I mean, I know that the constant bullish refrain that I hear is that there is an acute shortage of housing in America. True. But the key word that's not usually added is affordable housing. And the problem is most houses aren't affordable to the average person. So if you look at median income, I just heard Ivy Zellman talking about this. She's one of the most famous housing analysts out there. She said that the median income required to buy a home is the highest it's been since 1981, when mortgage rates were 16%. So obviously we're not dealing with 16% mortgage rates. We've only got, around 7, maybe a little bit below that, but the prices are so high, people just can't afford them. And you're now seeing, and this was an interesting comment that came out from Melody Wright, another housing expert recently with Adam Taggart, that if you look at existing homes, we wrote this up actually this week, they're trading above the value of new homes. It's only happened one other time previously in 2005, right before that housing bubble popped. So it's telling you something really extraordinary is going on. And the point that Melody Wright made is that actually the new home prices are even lower when you include all the sweeteners that the builders are putting in, the mortgage buy downs, the free appliances. So I think she said it was 40,000 more price discount than what we see in terms of the actual numbers. But that's just, it's unheard of. But that tells you that these builders have a real serious problem. So I'm very negative on the home building stocks right now, just in case you didn't notice that.
Okay, I know we're quite a bit over time here, but it looks like we have one more from Jeff.
Yeah, good morning.
Now afternoon.
Going back to the small cap, on the one hand, you're saying they're really undervalued, which I knew. But on the other hand, you're saying there's a lot of issues with debt and refinancing it. How does one play that if one believes that small cap is due for a revival? It sounds like you either have to buy them individually yourself, which can be hard, or you have to find a fund that is actively managed. Just an index of these things sounds like a potential issue.
think you're right. Jesse brought up Eric Cinnamon. I've read his work over the years. I think he's had a terrific track record. So you might look into his fund. I think he's still taking outside money. Do you know that, Jesse?
Yeah, I think he is. I think he's also still like 80% in cash. So, it's not a ringing endorsement of the, of the idea, but, yeah, I think the portfolio, that's invested is in mostly dividend payers within the space.
Yeah, me too. Okay, thank you, and I will take a look at your stuff, Jesse.
All right, everybody. Thank you for your patience.
Oh,
We'll
we've
be
got
talking to you.
we have one here from Jeff Jeff M. That is, any thoughts on industrial warehouse development? Overbuilt, about right, or is demand accelerating?
Well, I don't think that's a Jesse's wheelhouse. It's really not in mine either. Uh, I guess I would be worried that, there's too many of these AI data centers under construction. I don't know if that's really specifically what you're talking about, but I think that space has had a lot of capital go into it in recent years. It's been kind of popular, maybe too popular. I know Evergreen's got some of those in their income fund that have done reasonably well. I just think you have to be really careful and, look at the market, make sure it's not glutted, that particular region, make sure that the deal is structured well. And, real estate's very, very diverse. So it's hard to say things with a sweeping brush. I mean, just as some of you know, and this is commercial office rather than industrial, but we were able to buy the Smith Tower, be part of a group that bought the Smith Tower last year, maybe it was the year before, and we paid 30 cents on the dollar versus what Goldman had paid for the pandemic. We basically bought the building. It's one of the iconic buildings in America that have been, really nicely restored, and basically paid just a little bit more than what the parking garage itself was worth, a standalone parking garage. And so there's a lot of pain out there in the office space. I think that's where I probably would be looking, and some of these banks that just went out. But yeah, I think we're going into a period where there's going to be more of the stuff that comes up, and I know there's a lot of people believe that private credit, private lending has got tremendous excesses in it, and so that's probably going to lead to some good opportunities soon.
Okay.
Anybody else?
Jesse, I've got one on the Haymaker side, obviously, but just on AI in general. Is your impression that the captains of industry in Silicon Valley are actually fully aware of AI's limitations and they're hyping it for obvious reasons, for economic gain? Or do you think it actually is a movement of devout believers who do buy their own hype? I've had a hard time kind of assessing where the BS ends and the evangelical reality begins. So
I think it's a great question. I think there's a lot of fear that's driving it. Whenever we have these technological revolutions, there's so much disruption. And, I think Google is a very, maybe the most obvious example is that if you've tried ChatGPT or Perplexity or any of these, you start using these more and start using Google search a lot less. Mm-hmm. And, so there's opportunity on the one hand to take share, but there's also, the famous, creative destruction that happens on the other side. So I think all of these companies have a tremendous amount of fear that if they do not participate and they don't spend and they don't kind of try and be on the bleeding edge of this thing, then they're going to be, they're going to be on the bad side of that creative destruction equation. And see, there's, they're going to end up a Xerox copy or an Eastman Kodak, one of those types of scenarios. And so I think it's really more fear that's driving it, fear of not being disrupted. And we have to do this in order to try and preserve our place in the tech ecosystem. And that's really what drives all of these types of innovations. Sure. Now, you always see massive overspending, and it ends up being a great boon to the rest of the economy. But the companies that end up doing the spending end up, really not benefiting from that. And that's kind of what we saw with the .coms, what we saw at the railroads. It's what you see in every one of these cycles.
But one of the reasons I was asking is that some of the most religious language you hear in a secular world comes from some of the techno-utopians who they're absolutely certain of a singularity coming, and they're certain that AGI is around the corner. And it always sounds far more like, spiritual language to me than tech language.
Yeah,
So
yeah. No,
Well, there
that's
was just an
absolutely true.
MIT
And
report
if you,
that came out, right? The MIT report that was very, very derogatory about AI. Did you see that one? Or at
yeah,
least the articles on it?
95% of
Right.
spending so far has not led to any type of bottom,
That's the one.
net income, kind of gains for these companies. But it's also when you actually listen to the many of the researchers, and you listen to the head of Meta, has been saying this. Meta's lead AI researcher has been saying the same thing that Gary Marcus has been saying, which is none of this. Large language models are not going to lead to AGI. We need another massive breakthrough. We need kind of neurosymbolic learning, and that's going to need a much bigger breakthrough than just large language models. And the adding more data and more compute is not going to solve the problem. So
Neurosymbolic learning, is that what you said? Neurosymbolic?
yeah,
Boy, that's a buzzword
it's
I haven't heard
essentially
yet.
a completely different technology that's in really kind of more of an infancy than large language models.
yeah, there's a running joke in philosophy. I heard it from Daniel Dennett originally, but I think he was quoting someone else. But it's the secret of human consciousness is always 10 years away. And I wonder if AGI is going to be the same thing. It's
always.
Yeah.
Yeah. Well, Fred Hickey is somebody who's been following the space for a long, long time. And he's been, saying that we've had essentially this version of artificial intelligence, very smart algorithms that are able to accomplish things, menial tasks, more efficiently than humans for a long period of time. We had, IBM, we've had Deep Blue, winning chess matches and beating Garry Kasparov, and a lot of these innovations have been around for a long time. But we're no closer to AGI today than we were even 10 years ago, because LLMs are not going to get us there. It's not the technology that's going to make it happen.
I'm just wondering if the Metas of the world actually do believe it, or if they know what you know. Which So anyway, thank you for that, Jesse. Appreciate it.
Yeah.
Okay. Well, thank you, Jesse. Hope to see you in person soon.
Thanks for setting this up. Yeah, this was a lot of fun, Dave. Appreciate it.